Hi everyone, today we're going to be taking a close look at growth investing. Alright, so growth investing is a type of investing style that is focused on quickly growing the investor's capital or money, and this can be done in a number of ways. You can take equity in small businesses, which tend to grow faster than the big cap companies. We will get into why in the next slide. You can purchase stock in a company with a lot of speculation. So that's companies with positive, unconfirmed news that investors are hoping to be true. You can also invest in companies that are in high-growth industries, or if you don't want to invest all your money into any individual company, you can invest in an ETF. Now obviously growth investing comes with much higher risks than say value investing, because with higher growth comes higher risk. But anyway, small companies. Small businesses tend to be more adaptable to changing market conditions since they are less embedded in a certain market. For example, if everyone in the world suddenly started liking whole wheat bread, your local bakery can easily stop making white bread and focus on making whole wheat bread. Whereas a large baking company would struggle because they need to get rid of all their non-whole wheat inventory, change factory production, and resource new ingredients. Small businesses also tend to focus more on the product quality since they dish out less products. This can help attract more customers and scale the company quicker. Finally, small businesses can be much more innovative. They can afford to take risks since less is on the line, and all they need is one breakthrough to take their business to the next level. All these factors come together to result in high growth in successful small businesses, which is why they are a popular choice among growth investors. To demonstrate this, here we have two indexes. The first is the S&P Small Cap 600, which is 600 small companies with valuations from 300 million to 2 billion. The second index is much more well known, the S&P 500, which is composed of the 500 biggest companies by valuation. As you can see in the 10-year recordings of both indexes, the S&P 600 clearly has the higher returns, more specifically an average annual return of 14% over 10 years, compared to the S&P 500, which only did average 10% annually over the last decade. However, the S&P 600 is much more volatile. It cannot sustain a 14% annual return over the long term. There are decades where the S&P 600 loses value, whereas the S&P 500 has consistently sustained 10% over the last century. Next is companies with speculation. Speculation is forming a theory without firm evidence. In other words, it's a rumor. These rumors, when paired in with a bull market, where most stocks trend upwards, can send stocks flying. We saw this recently in CCIV. It was a company rumored to be taking Lucid Motors, Tesla's biggest competitor, public. This company itself never made such an official statement, but investors still decided that it was worth a shot and started hogging up the stock. The stock flew from $10 all the way to $64 in a few months, simply on the fact that the company might be taking Lucid Motors public. The second example is GameStop. It was coordinated by Reddit to topple hedge funds, and the GameStop squeeze was built upon the rumor that it doesn't matter what price you pay, it will only continue to go up and you're guaranteed to be making money. They were partially right. It did go from $20 to $483 in a month, but it came down equally as fast. It currently sits at $191 a share. So speculation is an extremely risky method, and you could be the one to buy in at the top and watch it tumble down. So it should not be used when trying to build a stable portfolio. Next is high growth industries. These are sectors of the economy that are expected to grow faster than average due to higher demand or better innovation. Obviously, with a bigger industry, companies must also grow to satisfy that demand. Therefore, companies in the high-growth industry is another popular choice among growth investors, since they are very likely going to climb fast. Current 2021 examples include the technology industry, which has been trending for a couple of years now. Popular choices in this industry include everything from software like Zoom, data analytics like Palantir, to well-established giants like Amazon and Google. Clean energy and electric vehicles are also on track for high growth, with Joe Biden as president. Popular choices in this sector include Tesla, which is in both EV and clean energy, SunPower, which makes solar panels, and NIO, which is considered as the Chinese Tesla. In addition to any of these individual companies, You can also choose to invest in ETFs if you don't trust any company in particular. ETF stands for Exchange Traded Funds, which are a vast collection of companies crunched into one security. ETFs can control which companies they include, so ones with a heavy emphasis on the high growth industries are going to be known as growth ETFs. Some of the best performing ETFs this past year include ARK Innovation, ARK FinTech, Vanguard Growth, and the S&P 500 Growth ETFs. Beside each of these, I have included the 1-year return in brackets, and as you can see, they dwarf the benchmark for annual returns of 10%. But once again, the faster the growth, the higher the risk. So over the past few weeks, the markets have been unstable, and both ARK ETFs are down about 20% from their all-time highs, while the SPDR is actually at its all-time high right now, and VUG is only down about 2% from its all-time high. So in conclusion, growth investing, when done properly, yields much better returns than something like value investing. However, it does come with the higher risk, and you must be aware of how volatile growth securities are. They might go up really fast, but they can come down even faster. And finally, growth stocks are not something you buy and forget about. They need to be watched closely, as their best period of performance varies from stock to stock, so it can go from a month all the way up to a year. And that's it for today's video, and I hope you learned something new.